Okay, hello everyone. This time that this file, we are going to go through the summary of hedging strategy using futures and forward rate agreement. So this is a tutorial that I gave you in Word file. We want to talk about some questions related to the FRA contracts. And before that, the first part actually we learned that in the midterm exam, which is regarding the optimum hedge ratio of how do we calculate the number of a contract we should long or we should short in terms of a hedging strategy by using futures contracts. Okay, this file is a Word file, so therefore I made a lot of notes already because using my writing pad is not very sensitive in the Word file. But the first part, I will try to write it, but the second part, when it comes to the calculations, actually I pre-write. So later I will also upload this file with my notes online. So therefore you will know like each questions, how do we compute it? Okay. For each numerical question, I actually put down the calculation procedure. Okay. So that case you don't have to worry. Right. If that's the case, let's get started. So first of all is a quick revision about how do we compute the hedge ratio. If you still remember, is the HR, right? So define, compute, and interpret the minimum variance hedge ratios and hedge effectiveness. If you still remember that we learned this equation here, the HR equals to the tau SF, which is the correlation, and then sigma S would be the spot volatility, and sigma F is the futures underlying volatility. Okay, and if they are identical contract, basically they should have equals to zero. That means their underlyings have the same volatility. Okay, so hedge ratio is the ratio, the size of the futures position relative to the spot position. The optimum hedge ratio, which stands for HR here, is the minimize of the variance of a combined hedge position defined as follows. Okay, and then we also then how do we compute it? The tau, which is the correlation, right? So correlation tau would equals to covariance SF divided by sigma S times sigma F. Okay, and occasionally we can also translate it to the beta. This is for the index. If we are hedging the index futures, normally we will use the beta directly, which comes covariance between the spot and the market and sigma market square. Okay, so for the index, that F is literally the index market index sigma, right? So this is a sigma M square, if you still remember. Okay, and this is the generalized model covariance SF divided by sigma F square. All right, here are all definition of the variables. The effectiveness of hedging measures the variance that is reduced by the implementation of optimum hedge ratio. So that means, for the risk you perceive in the underlying position, the cash position, how many contracts in terms of the futures you should hedge, either long or short. So later on, if you still remember, we introduced you the beta star instead of beta because by the sign of computation, you are able to determine that whether you should long or you should short. The effectiveness can be evaluated with the coefficient of determination R squared. That's the fitness, right? And then where the independent variable is changing futures price and the dependent variable is changing spot price. Recall R squared measures, if you still remember, that's the statistics. Measures the goodness of fits. Okay, the higher means your model is better estimated, is having a higher or better goodness of fit of the regression. Okay, as shown previously, the beta spot with respect to the futures price equals to the hedge ratio, which is also the slope of this regression. Okay, so basically a whole sentence or paragraphs just to discuss, most importantly, these two equations. First of all, how do we estimate the correlation between the two variables, which is the sigma S and sigma F? okay, or SNF. Secondly, how do we compute it, the optimum hedge ratio? By incorporating the correlation between two products, SNF, or the income, also together the relative risk level, which is sigma S divided by sigma F. Okay, and then following, we will apply this formula in adjusting the portfolio beta. So here, actually, later on, we introduce a new figure, beta star here, right? Which is our target beta. So come from the old level beta to the target beta, how many contracts we should long or short, okay? So taking a look of the definition, hedging an existing equity portfolio with index futures is an attempt to reduce the systematic risk. This systematic risk is referring to beta. If the beta of the capital asset pricing model is used, which we use it to compute the beta systematic risk, then the hedging boils down to the reduction of portfolio beta. That's beta be our portfolio beta, beta star be our target beta, right? So this is literally what we learned before. Beta is the old beta, beta star is the target beta. After we implement the strategy with index, P be our portfolio value, A is the value of underlying assets. To compute it, the appropriate number of futures we use as the following. Okay, so here is the number of the contract we should hedge. P is the portfolio value that we are intending to hedge, and A is basically number, the amount of the assets. Or sometimes you can use the futures contract size as well. Okay, so alternatively, some people will use the portfolio value. This is the total value we want to hedge with the F. Okay, so this is the basically the contract size for each underlines. Contract size. Okay, and then P stands for portfolio value that we intended to hedge. Okay. And then we know that already, if this is positive, then we should go on to long more contract. If that's negative, we should go on to short more contracts. Okay, so let's take a look at this example, which we went through before already. Suppose we have a well-diversified 100 million active portfolio. The portfolio beta relative to S&P 500 is 1.2. That's our old beta. Current value of S&P 500 is 1080. That's the index, right? And then remember, you have to apply to the IVP, index value per point. Portfolio manager wants to completely hedge. So that means the beta star equals to 0 because you want to fully hedge your systematic risk. And then demonstrated how to adjust the portfolio beta. To fully hedge, that means our beta star equals to 0. And our original beta is 1.2. So number of contract will be 0 minus 1.2 multiplied by 100 million divided by our contract size is 1080 multiplied by IVP, right? So the answer would be minus 4444.44. And then this is a round up number. Okay, so we should go on to short 444 contracts. Okay, this is pretty straightforward. We learned that before already. So generalized model is this one. Okay, number of contract portfolio beta times portfolio value over the value of a futures contract, or can be the spot position value as well. If you refer the futures and the spot position is the same level, 1080. Okay, and the better way is beta star minus beta, right? Okay, and the following is tailing the hedge. Remember, tailing the hedge, the key point is that we are adding one more term into your computation of number of contract, which is the quantity of the asset and quantity of the futures. And then we are basically in total trying to compute the relative figure of value of contract and value of the futures rather than the quantity or price only. Okay, that's the telling the hedge. So multiply by PA over PF. Okay, and we went through some of example already. The key points of this tutorial is to try to learn the definition of another very important futures and forward contract, which is what we call FRA, is a short-term forward contracts. Okay, and FRA forward contract, basically, again, you can standing at long or short positions. So therefore, when we computed the value of the FRA, there are zero-sum game. Okay, so basically the formula is the opposite. I think we went through this already. So let's take a look at the definition first. A forward rate agreement, FRA, can be viewed as a forward contract to borrow. If you borrow, that means you buy. And then later on that you pay the interest. So you borrow the money. To lend, which means you short or you sell. So later on you will receive the interest. Money at a certain rate, which is your K, delivering price or interest, at some future days. In practice, this contract settle in cash, but no actual loan is made. So we just computed the differences into the interest. And in that case, we are able to compute in the gain and losses in these FRA contracts. So this means that the credit worthiness of the parties to contracts need not to be considered in the forward interest rate. So we just straightforwardly looking at the price differences or interest rate differences in this particular FI contract, we are able to compute it gain and losses. Okay, so essentially risk-loss rates such as LIBOR can be specified in the contract. So basically everybody is using the same reference rate. So take a look at the second paragraph. The loan position, which is the buyer of the FRA, is a party that will borrow the money in the future. Okay, so loan the loan with the contract price to be interest on the loan. So that's the price to pay. You can see here, I draw the diagram for loan FRA, and this is our exercise price, which is the K, delivering price. Okay. So later on that, if we end up with the FT higher than K, then we earn money. We know that already, right? So how do we compute it? The loan FRA profit, the formula is here. So remember, yeah, this is for loan. Present value of the FRA is NP. NP stands for nominal principal. Okay, we need to know the whole contract size. So that's our nominal principal. Times the FT minus K. FT is the basically the expiration day, futures price or forward quotation, minus K is our exercise price. Okay, so here can you write down K is the exercise price. Okay, and remember, yeah, we are trying to compute in the present value. Okay, so that case, you are standing at some time to looking at 6 day, 90 days FRA. So you have to discount it back, okay, by using the future forward rate quotation as your discounted factor. Okay, so divided by 1 plus FT times the duration, which is the days over 330. Okay, now I want to teach you a term. FRA will tell you like this is a 1/3 or 1/4 or 2/4. How do we determine that? This is our signing day of the contract. Today, you sign the contract, okay? And then say this contract that will be expire 1 month later, okay? And 1 month later, when you compute it, your gain and losses, you are based on the 3 months quotation. Okay, so in that case, this is what we call 1 times 4 FRA. Okay, so remember this terminology, 1 times 4 FRA in terms of a month as a unit. So that means we sign the contract today, and then we will compute our profit and loss after 1 month. So 1 month, first one is our expiration day. So after 1 month, we computed our gain and losses of this forward rate agreement. And standing at 1 month, you are computing based on 90 days, which is a 3 months interest after 1 month. Okay, so we actually exercise 1 month later. And then you are computing gain and losses based on 3 months interest 1 month later. So this is what we call 1 times 4. Okay, so that case, when you computing the PV, you are computing present value of the FRA 1 month later. But then because you are earning 90 days interest, so you are discounting back for 90 days. That's the case. Okay, a little bit complicated. We can take a look at the example here. Okay, actually, I draw diagrams here. FRA, it will give you the term. If this FRA is 1 times 4, that means signing today, it will expire in 1 month, which is 30 days. And then after 30 days, we are taking for 90 days FRA quotation. Okay, so basically, 4 is the total length of your trading. Okay, 4 equals to 1 plus 3. So this is why we call it 1 times 4 FRA. All right. So take a look at this example. Consider an FRA that expires settled in 30 days. So you know that basically you will compute your gain and loss in 30 days. Okay. And 30 days based on 90 days liable. All right. So here you see your expiration day, contract day to settlement A is 30 days. Okay. So that's 1 here. And then your nominal principal is 1 million. That's the MP. And after 1 month, you are computing your interest based on 90 days liable. So B minus A, B is your total length. B minus A would be equals to 4 minus 1 equals to 3 months in this case, okay? Equals to 3 months. So you are based on the 90 days liable rate to compute your PV, okay? So PV, you are computing actually after 1 month, which is your expression day of the FRA, okay? Specify for a rate of 5%. That's your exercise price or delivery price, which is our reference rate in order to compute it your gain and losses. Okay. Importantly, as I just mentioned, long and short FRA, they have a different formula. Okay, for the long FRA, you will earn money when FT is higher than K. Okay, so the difference is here. So basically, when you computed the gain and losses, you are using FT minus K. Okay, and then days over 360, in our case here, it would be 90 days, right? Because we are looking for 90 days interest length. And then remember, yeah, that's how much you will earn after 90 days. But we are standing at 1 month later, so you have to discount your profit after 90 days back to 1 month, okay? So you will discount it back 90 days to compute it your present value, okay? So here, to be more specific, is a PV, okay? Present value of your loan FRA. So divided by 1 plus F0 is your after 1 month the market quotation. In our case here is 6%, okay, and days will be 90. All right, so apply all the number into your computation. It will be MP, this is MP, 1 million, times FT minus K. FT is 6%, according to the question here. Minus K is our exercise price or delivery price or contract price, which is 5%, 0.05. And then multiply by you are based on the 90 days FRA. So 90 over 360. Remember, because FT and K, they are annualized quotations. So you are computing 90 days, which is 3 months only. Okay. So 2,500. This is the present, this is not the present value yet, okay? So this is basically the settlement day. So at 1 month, at 4th month, 90 days later, okay? So this is not yet the PV. PV is here, which we have to discount it back for 90 days, okay? So discount back for 90 days. Okay, so basically what it means that is we have a 4 months FRA, 1 month and 3 months. Okay, your 2,500 is here. And then if we want to compute it, the PV, you have to discount by 3 months. Okay, that's the case here. So PV would be the 2,500 divided by 1 plus FT is 6% times 90 over 360 because you discount it back for 90 days. So the answer would be 2463.05. So this is standing at 1 month later, okay, which is the expiration date for your contracts, okay? So pay attention to here. And then one thing I want to remind you, this is the formula already, is the short FRA. So here are actually two formula. The first one is your PV of the long FRA. The differences is here. When we computed gain and losses for long contract, you are using the maturity floating rate, the market rate, FT minus K. This is where your exercise process. And then when you are computing the PV for short FRA, okay, the only difference is here, you are doing the opposite. You're using K minus FT, okay? So these two formula also, again, means that long and short is a zero-sum game. Okay, is a zero-sum game. The rest of formula are actually the same, okay? So that's our example of the FRA. All right, so we have some tutorial questions. So when we come up to the FRA, we will explain in more detail. Let's go through the question one by one. First of all, a fund manager has a USD 100 million, that's your PA, with a beta 0.75, that's the O beta. The manager has bullish point of view, so plan to actually enhance the beta. So in this case, you want to increase the beta star rather than reduce, right? And then the current level of S&P 500 is 1,250. That's the point. So you have to multiply by your IVP, 250. Risk-free interest rate is 6%. We don't need the information here. So take a look at number of contract here equals to beta star is 1.8. Beta is 0.7 multiplied by PA 100 million and your PF is 1,250 times 250. So the answer would be positive. Remember, because you loan more, 336. So the answer is B here. Question 2. Consider an active portfolio which market value is USD 100 million. So that's the PA again. The beta is 1.5. That's the old beta. And then current S&P level is 1,000. That's your index, okay? And then index value per point 250 will be beta reduced to 0.8. So this time your beta star is 0.8 minus 1.5 multiplied by your PA, which is 100 million, and over PF, which is 1,000 point times up 250. So you end up with minus 280. So we short 280. Okay, question 3 is about the hedge ratio. A company expects to buy 1 million barrels of the West Texas intermediate crude oil in 1 year. The annualized volatility for the price for the WTI is calculated as 12%. That's the sigma S. The company chooses to hedge by buying futures contract at Brent crude. The annualized volatility for Brent futures is 17%. That's your sigma F. Okay, 17% is your sigma F. And the correlation, which is the tau, is 0.68. Calculate variance minimum hedge ratio. So a hedge ratio equals to tau times sigma S over sigma F. So 0.68 times 0.12 times 0.17. So the answer is 0.48. So hedge ratio would be 0.48 in this case. Okay. And question 4 is about the FRA. Let's take a look. A CFO of a major company wants to hedge against the possible interest rate increase. So if you want to hedge increase, that means you want to have a FRA when the price goes up, you earn money, right? So in that case, you should go on to long FRA. Okay, so this is a long FRA. So when the price goes up, you earn money, right? So the foreign course obtained dealer for 30 days FRA. So 30 day would be your expiration day, right? And then you have a different quotation, 60, 90, 180. So remember, that's the court's 30 days after, okay? And then for the 60, 90, and 180. Take a look. So the contract covers nominal principal 50 million, that's your MP. Company has a risk against 60 days liable. So we are taking the 60 days quotation in that case, okay, which is 0.048%. And the 30-day later contract expires, 60-day liable is 5%. So that's the quotation for the market interest rate 5%. Company collects or pay from the dealer. So remember, yeah, you have a long FRA. So the formula will be MP 50 million times, this is the FT minus K, right? And here in the denominator, in your bottom is 1 plus, here is the FT times the T over FRA. And T, we are looking for 60 days, okay? So the answer would be positive. We are earning money. If you see the diagram here, because your exercise price is 0.048 and you end up with 5%. So we earn money in this FRA, right? You earn 1,600, 529, okay? So remember, yeah, this FRA is what we call 1 by 3 FRA, okay? So expire in 1 month, and after 1 month, you are computing based on the 2 months interest rate quotation, and the PV day would be end up of 1 month. This is where we computed the PV. Okay, the answer would be A. So at the expiration of libel-based FRA, the party holds a short position in FRA. Well, okay, so this is the short FRA diagram, right? You will earn money when K is higher than FT. You will lose money when the K is lower than FT, basically. So the answer is C. Receive a payment when your FT is lower than specified in the FRA. Okay, so answer C is correct. Question 6, again, is the hedge ratio. The hedger calculate covariance between the spot and futures is 0.05, that's a covariance, okay? And then the spot standard deviation is 0.3 and the future standard deviation is 0.2. What is the optimum hedge ratio? So remember, another formula is covariance divided by sigma f squared, right? So here are the information we have. So 0.05 divided by, remember here, yeah, sigma f is 0.2, you have to multiply, take a square, okay? So 0.2 times 0.2, your beta is 1.25. That's the answer, okay? If you are having a covariance instead of a correlation, you are using this formula. All right, the following is another questions to compute the HR. A company is going to buy 10,000 barrels of West Texas crude oil. It plans to hedge the purchase. So remember, you're going to long hedge using the Brent crude oil contracts. Correlation between the spot and the futures is 0.72. That's the tau. Volatility for spot is 0.35. That's sigma S. Volatility for Brent crude oil 0.27, that's sigma F. So HR is tau times sigma F over sigma S over sigma F. So the answer would be 0.9333. The answer is B. You can take a look and try to compute yourself. Okay, question 8. The current value of S&P 500 index is 1457. Remember, that's the point. And then deliver US 250 times. So that's the IVP. Long only equity portfolio with market value USD. This is 30 million. Yeah. Or 300 million. 100,000 has beta 1.1. That's your original beta. To reduce the beta to 0.75, that's your target beta, right? So basically, we just put all the number into the formula. Beta star is 0.75 minus beta 1.1, and then multiply by your PA, which is 300, 100,000, divided by 1457, multiplied by 250. So end up with minus. So you go on to short 288 contract. The answer is B. Okay. European bank wants to short a 1 times 3 FRA. So remember, 1 times 3 means you expire in 1 month. This is 1. And then we are computing the PV here based on 2 months FRA. So 1 month plus 2 months is 3 months. So this is what we call 1 times 3 FRA. Okay, so we are computing based on 60 days quotation. All right, so this question is simple. We don't have to do computation, but it's just asking what Euribor rate would most likely result European bond receiving payment from the dealer. So you short, right? You were receiving the money when your FT is lower than 1.75, and it should be based on 60 days. So it could be answer either A or B, but this quotation needs to be lower than 1.75. So the only answer would be A, you earn money. Okay, so this question triggers 2 potential questions. One is that the dates. Okay, so 1 times 3, then that means you are vesting on 60 days. Secondly, you have to earn money in this short position. So that means your FT needs to be lower than K. Okay, so the answer would be A. Final question. Investor goes on long FRA expiring in 30 days with the underlying 90 days. So basically, this is a 1 times 4 FRA. Okay, because you are vesting after 1 month based on 3 months FRA quotation, okay, which is the 90 days. At expiration, 60 days 3.5%, 90 day is 4%. So we are using the 90-day quotation, right? Because it's 1 times 4. So basically, you are computing your PV here based on 90 days. Okay. So the answer would be 10 million your nominal principal NP times 0.04. That's the 90-day FRA. That's your FT minus your K. According to the question, is 0.045%. Okay, your K is 0.045%. And then times the day is 90 over 330, 60 days. Okay, that's your K here. And then divided by 1 plus, remember, that's the FT as well. Okay, 4%. And then 90 over 360. So the answer is 12376. Okay, that's our answer for this question here. All right. I think I kind of cover up this circle here, so it's better for you to. Okay, so here you can see that the K is 4.5 and this is your FT. Okay, I think this way is clear. So that's the FT minus K in terms of a long FRA here. Okay, and then that's negative because we lose money. Okay, 4 minus 4.5. Yeah, and your NP here is 10 million. Okay, so that's it for this tutorial. Thank you so much.